Welcome to the Valuation Desk by Highland Global, where SBA business valuations speak bank. In this session, I want to talk with you about a topic that often causes confusion in SBA loan underwriting: leasehold improvements and how these are treated in a business valuation. Now, I know it can seem like a dry topic at first glance, but I promise you, this has real implications for deal structure, valuation accuracy, and ultimately loan performance. Let's start with a simple definition. Leasehold improvements, also known as tenant improvements or build-outs, are changes made by a tenant to a leased property to make it suitable for business operations. Think of a restaurant installing a commercial kitchen, a dentist putting in exam chairs with plumbing, or a retailer adding custom lighting and shelving. These are capitalized on the tenant's books and depreciated over time, usually over the term of the lease. But here's the key question: do they add value to the business being acquired or just to the landlord's building? From an accounting perspective, leasehold improvements are depreciated assets. From a valuation perspective, they're usually treated as sunk costs. Unless those improvements contribute directly to the business's future cash flows, they don't typically factor into the appraised value of the business. So even if a business spent hundreds of thousands of dollars on a build-out, those costs don't automatically increase the business's value. Let's talk about what we mean by sunk cost. A sunk cost is money that's been spent and can't be recovered. That's exactly what leasehold improvements are in most cases. You can't take them with you. You can't sell them off. And if the lease isn't assignable or the improvements are too customized, they're worthless to the buyer. They might still be on the books, but from a valuation standpoint, they're gone. Here's the irony. Leasehold improvements usually benefit the landlord more than the tenant. Once installed, they become part of the real estate. If the tenant moves out, the landlord keeps the improved space and often charges more for it. It's like giving your landlord a free remodel. That's why many appraisers describe tenant improvements as an economic gift to the property owner. Now let's look at this through the SBA lens. Under SOP 5010-8, leasehold improvements are not considered tangible collateral unless the borrower owns the real estate. So for business-only deals, tenant improvements are not counted as value unless they contribute to cash flow, not treated as collateral, not added back in valuation unless there's clear evidence of transferable benefit. If the lease isn't assignable or if the improvements aren't essential to operations, they're irrelevant to value. Let me give you a real-world example. A buyer is acquiring a pizza restaurant. There's a $200,000 build-out in the kitchen. The lease is non-assignable without landlord approval. The buyer wants to open a sushi concept. What's the value of that kitchen? To the buyer, probably zero. It's a sunk cost. It doesn't support their intended concept, and they can't sell it off. To the landlord, it's a win. They now own a building with a fully equipped commercial kitchen, thanks to the outgoing tenant. So what does this mean for you as a banker? When reviewing a valuation or an SBA loan file, check whether the lease is assignable. Confirm whether the build-out supports future cash flow. Don't treat tenant improvements as part of the business's fair market value unless clearly justified. Always remember, just because a borrower spent money doesn't mean there's value for the buyer or security for the lender. To sum it up, leasehold improvements are usually sunk costs to the seller. They benefit the landlord, not the buyer. In most SBA transactions, they should not be factored into business value or collateral. And unless they support future cash flow and are transferable, they don't belong in the valuation. So next time you see a $150,000 build-out listed in a CIM or seller memo, ask yourself, does it actually increase the value of the business or just the value of the building? Thanks for joining us for this episode of the Valuation Desk. At Highland Global, we bring decades of hands-on experience to every appraisal we deliver. SBA lenders trust us because we understand what's at stake: accurate, credible valuations that withstand scrutiny and support sound lending decisions. Our deep knowledge of SBA requirements, valuation principles, and industry-specific nuances makes us the go-to choice for lenders who demand expertise they can rely on. For more information on valuation-related topics, be sure to visit our website, highlandglobal.com. Lenders know experience matters most.